So in this video, we're going to be talking about moving averages. Moving averages are, without a doubt, my personal favorite indicator as to analyzing markets and where they may go. Now, once again, you are never to trade with one indicator and one indicator alone. You should have at least three suggesting, yes, it's going to go up, no, it's going to go down, and so on. Moving averages, there's two we're going to focus on. There's many different moving averages. There's two types we're going to focus on. You've got your SMA, which stands for Simple Moving Average, and you've got your EMA, which stands for Exponential Moving Average. Just for simplicity purposes, I'm going to be showing it in the Bittrex exchange right now. Most exchanges are going to give you these type of tools to use your analytics and do your technical fundamental analysis and so forth. I do prefer to do a lot of technical analysis in Coinigy just because there's so much you can do, and you can print and you can save charts and you can compare and you can look at multiple exchanges at once, etc. But for simplicity, you might find yourself just going, I'm going to just stick to the exchange I'm on and keep it that way. So you go into studies and you'll see moving average. Now it's going to let me choose a simple, an exponential, a weighted, etc. It's just these two that I'm going to focus on, and for the most part with technical analysis, you're only going to use these two. So I'm going to go simple, and then you see period. I'm on a 30-minute calendar right here, so every single candle is 30 minutes. If I kept this period at 50, that would mean 25 hours. Typically, very common moving averages are going to be 10, 13, or even 30 if you're looking at a wider range. I'm going to usually use a 10, a 13, a 15, somewhere in there. On my shorter analysis, meaning, 30-minute calendars, I'm usually going to use a very closed period because it's going to follow the market more closely, because there's so much going on. When you zoom in, you see so much activity. And so to successfully track that activity, you're going to want your period to be very zoomed in, 10, 12, 15 period on a 30-minute calendar. Now, if I was doing a one-day spanning out looking at analyzing a swing trade or a long term, then I would probably be using an 18, a 20, a 30, somewhere in there to analyze very apparent market changes from a swing trade point, right? I wouldn't really be caring about the tiny little 100 Satoshi up, 100 Satoshi down on a day-to-day profit. I'd be more looking at the 200, 300%, 500, 1,000, 20,000% gains over a period of a couple months, a few months, a couple quarters, and so on. So with this, I'm just going to bring this down to, let's just say 13. That's going to analyze about 6.5 hours at a time. So I have it as a period of 13, which is going to be 13 candles, aka 6.5 hours, because we're on 30 minutes. I have the simple, and the simple moving average is going to be red. I'm going to click create. Now the first thing I want you to take note of is, if the market is below the simple moving average, if the market is below the simple moving average, like right in here, that means the market is bearish, and also right in here. If the market is above the simple moving average, that means it's bullish, like what happened right here, and right here, and right here, and right here, and right in this area. Bearish is below, bullish is above. Okay, so that's your simple moving average. What it's doing is it's taking the average price in a 13 candle period, aka 6.5 hours, and it's creating this line with it. So the market is going up here and down here and kind of leveling out. And this line, this simple moving average, is created by the average price over that 13 candle period, right? And that's what your simple moving average does. It weights each candle with the same amount of importance. It takes the average of it and then it creates the line. That's your simple moving average. Then you've got your exponential. So I'm going to go back here, moving average. I'm going to make sure that I have the same period. It would be ineffective. It would not be effective if you had your simple moving average at a period of 13 and your exponential at a period of 20. You want to keep them the same when you're analyzing. So I'm going to do that, and I'm going to click exponential and then scroll down here, and just to make it easier, I'm going to change this color to black so that way you can see. Then we've got our exponential. Now you can see these two weave back and forth and they cross each other and all that. I'll explain that in a second here. What I want you to understand about exponential now, it's also using a period, in this case, of 13 candles, aka 6.5 hours, but it weights the candles differently. So, say for example, it was starting out by weighing this candle right in here, this long green one. Let's just say that this was the end of a 13 candle period, okay? And it was weighing this one. What it's going to do is it's going to give this one a 1-to-1 ratio. It's going to give this a 1-to-1 value. The previous candle is going to give a 1 out of 2, a 1/2 value. The previous candle is going to give a 1/3 value, and then a 1/4 value, then a 1/5, and a 1/6, and a 1/7, and a 1/8, and a 1/9, and a 1/10, and 1/11, and 1/12, and 1/13, becoming exponentially less important or less weighted as it goes back in that period. That is why it is called the exponential moving average. So you've got a simple moving average, and you've got an exponential moving average, SMA, EMA. Now, something to take note of is where they cross. Where they cross is oftentimes an indicator, not always. Please be warned, it's oftentimes an indicator that there is a change in the market or change in direction. So for example, that is very notable right here. Do you see where it comes down and they're kind of on top of each other and they cross right here? Where they cross right here, look what happens with the market. It goes up and then it kind of goes up, comes back down, goes up, and then look, they cross again. And where they cross again right here, they're not only crossing, but something else to take note of is when they cross and they point in a different direction. They're literally pointing. They're saying, hey, it's going this way. It's moving this way. This direction. Look over there. That's what it's doing. And so not only does it cross here, which signifies, hey, there might be a change, but it also points downward sharply. And when you see that, that's a tank. So that can be used as an indicator to enter or exit into a market. And you can see here, it comes down and it crosses again. Why would it cross again right here? Well, look what happened is it kind of hit a bottom and then it corrected and came up for a second. And then it came back down and they crossed and it came back down, moved up. And once again, you can see it doesn't always cross, right? It crossed again here and shortly after the market continued going down, and it crossed again here and it came and started to go back up. Now, this follows the chart. It doesn't precede the chart. It follows, okay? It doesn't come before, it comes after. It follows the chart. So you can't go, oh, okay, it's changed, it's crossed, boom, here's what's going to happen. What you need to understand is when it crosses, it's already starting to happen. So I'm going to actually go to a 1 day, and I'm going to show you this on a better scale. We're going to get rid of both of those. And I'm going to take the moving average and I'm going to go simple, but I'm going to bring this to, let's just say, let's keep it at 13. We'll keep it at 13 and we'll create that. Red will be our simple, and then we'll go to moving averages again, and then we're going to change exponential. We'll make sure our period is the same. Once again, I want to make sure that the period is always the same when using these and bringing them both up on charts. Going to make our exponential black and create. Here's where this comes into play to leverage entering and exiting markets. So say, for example, guys, that you're looking to enter into this coin somewhere around here. You see that it's fallen down in value and it's kind of leveled out right in here, and all of a sudden you see that it crosses and it starts to go up. It crosses and the moving averages start to point upward. Well, it's crossed, which signifies a change or reversal, right? So you go, okay, well, it's crossed, something might happen, but it's followed by an upward pointing average. You decide to enter the market. I'm going to use a little tool here, segment. So you see that it crosses right here, right in this area, and then you go, okay, well, it's crossed, and then you see that shortly after that it starts to go up. Well, say you decide to enter somewhere in that area. So you enter somewhere right in here, okay? Well, you've entered at 206,000 Satoshi. Well, it continues going up, and it goes way, 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 way up, and maybe you decide to make a sell here and along the way, and you do pretty good there, and that's great. And you make some really good sells. But then it starts to pull back. The market starts to pull back, and the moving average crosses again. If you relied on the moving averages to enter into trades and exit trades, You won't necessarily capitalize at the top of the market, but you'll play it safe. Because, gosh, if I entered in at 206,000 Satoshi because I saw the moving average cross, and then it actually started to point upwards, signifying that not only is there change, but it looks like we're moving into a bull market. I could have seen that and gone ahead and said, okay, I'm going to enter when it crosses, or I could have played it safe and said, okay, it crossed, but let's see what follows it. I noticed that it's followed by the moving averages pointing upwards, so I decide to enter at 206,000 Satoshi. It comes up. Heck, maybe I make some sells and I capitalize on this, but I still hold some of the coin, and then the asset corrects. The moving average crosses again. Well, then I decide to sell out right there because it's crossing, and I'm able to make a profit between 206,000 Satoshi and 260,000 Satoshi. That's pretty good. That's pretty good, right? That's a 22% gain. It's a 22% gain. So, cool. I sell out. But then it kind of goes along here, and then, oh, look, it crosses again right here. It goes, and then it points downward. Maybe a great time to buy somewhere in that area. So I buy somewhere in here. And then look, it crosses and it starts to point upward. Okay, I'm going to take advantage of that. So I own this coin for somewhere right in here. I re-enter the market because I see it not only cross, but I see it cross and point upward. So I go up and up and up and up, and maybe I capitalize and sell, and then the market starts to tank. I get scared, but the moving average crosses and it's still pointing up, and I go, okay, maybe that was just a small correction, and I'm able to capitalize out here, and maybe I make a sell right here. So it serves as a purpose to find momentum reversals or momentum changes. And it's not only important where it crosses, but also what direction it's facing after it crosses. So I look at those two things with moving averages. You've got the simple moving average, which weights each candle the same. You've got an exponential moving average, which takes the period and it exponentially weighs each candle less as it goes back in time. And that creates your exponential moving average. If the market is above the moving average, it means it's bullish. If the market is below the moving average, it means it's bearish. Now, not always, but oftentimes it will serve as an indicator, especially when you see it cross and point in a certain direction. So I have a couple choices to make. I can say it crosses, I can take a risk and buy, or I can say it crosses, I wait a little bit, I might not buy in the very bottom of that particular market, but I buy close to the bottom, I see it go up, and then I decide to buy. And then it continues to go up. Moving averages have a gap. They stay away from each other. I capitalize. I say, you know what? I'll make some sells. I'm not going to wait for the moving average to cross again. I make some sells. I make some sells. It crosses. It crosses. Then it actually starts to head downward. Maybe I consider selling out. It meets a level of resistance here. It crosses again, and then it points downward. Okay, well, that might be a sign to go, you know what, I'm not going to buy anymore. Maybe I'll sell out some right here before it goes into a bear trend and I lose it and I don't get the opportunity to sell out. Maybe I'm going to, liquidate more of my assets here. But then wait, I see that it crosses and then it crosses again and starts to go up. Okay, it crossed again, but now it's going up. Maybe I buy in. I ride this out, make some sales up above it. Everything's doing good. The market corrects, and after that, the moving average follows. And then I make another decision. Do I buy? Do I sell? So moving averages are a very, very, very good tool to analyzing what a market could potentially do in the future. Not only does it matter where they cross, but it also matters what direction they point. If you're at the top of a very apparent bull trend and they cross and point downward, well, that's oftentimes a sign that the market's going to tank. If you're at what appears to be the bottom of a very apparent, you zoom back on the chart, you see it's a very apparent bear trend, and all of a sudden you see that the moving average crosses, volume has slowed down, and all of a sudden the moving average is pointing up shortly after. That might be the sign of a bull run. So you look for that. Moving averages are going to follow the average of the market, and when you see them cross, when you see them change direction, and when you also see a volume change, those are indicators. Not always. As you can see in here, look, it crossed back and forth a couple times, and we kind of just played tug of war in this area. Not tons of opportunity in there, not tons of volume. So you got to take it with a grain of salt. Moving averages follow the flow of the market. They follow momentum reversals. So you look for where they cross, what direction they're pointing, and you look for a change in volume. You use that as one indicator to make your decision, and then always use at least two more. I'll see you in the next video.